Deepak, over to you.
Good evening, everyone. Welcome to the digital launch of a second tranche of Bharat Bond. Bharat Bond, as you know, has been the India's first corporate bond ETF. It's a Government of India initiative launched by us, and it received a tremendous response from all kinds of investors. Now we are ready with our second tranche. Here we'll be launching maturities of 5 years and 11 years. To talk about it in detail, we have with us CEO Edelweiss Asset Management, Radhika Gupta. What I will do is that to request her to give us some context behind the entire Bharat Bond program and the current series, post which I'll ask some questions on your behalf, and then we'll open up further for Q&A from participants. So thank you everyone for joining in. Over to you, Radhika.
Thank you everyone for joining in this webinar, and we hope the next 1 hour will be used to clarify all your questions about Bharat Bond. I also realize that people are still continuing to join, and we hope, as Deepak says, to take your questions at the end. What I'll start, as Deepak said, is by giving some context on the Bharat Bond program. So Bharat Bond is an initiative of Government of India. It is run by the Department of Investment and Public Asset Management of DPAM, and it was actually launched by the late FM Arun Jaitley ji in the budget 2-3 years ago, and it had 2-3 objectives at that time. One, and most importantly, was to give investors like yourselves a very credible alternative to invest in good quality fixed income instruments of India's public sector companies, jinko hum Navratna Maharatna kehte hain. I think that was the primary objective. The second was that a lot of public sector companies today, good public sector companies, whether it's NABARD or NHAI or PFC or RFC, these are borrowers, but they are largely borrowers in the institutional market. How could these borrowers talk to retail investors? And the third was, and many of you have read and heard about bond markets, that a product like this would be good for the development of India's bond markets. So that was the vision with which Bharat Bond was launched. Edelweiss, this is a labor of love for us. We've been working on this project for now 1.5 years from when we won the design of the product and the mandate. As Deepak said, we launched the first series in December 2019, and that was the first launch. We brought it to the market very quickly, and at that point we launched 2 products. We launched a 2023 and a 2030 product. So they were 3-year and 10-year products at that time. The contours of the product were that both were essentially, this is a debt ETF. It invests in bonds of the highest rated public sector enterprises. So these are companies that are owned and managed, and the owned and managed is very important. Owned and managed by the Government of India, central public sector enterprises as we call them, and they are AAA and only AAA rated central public sector enterprises. So it is the highest rated AAA borrowers of whose bonds we are buying in this ETF. And each ETF is structured to give you something that is very important. I think when you look at fixed income, there are a few things that you look at. One is you look at your safety of capital, and there's so much that has happened. I'm sure Deepak will ask some questions about that. And there we addressed it with these CPSCs. But the second is when you are an FD investor, you look at itne saal mein mujhe kitna milega, how much will I get in how many years? And that is why we created this structure called a target maturity structure. That meant that we buy, if we were doing a 2025 structure, for instance, as Deepak said in this issue, we will buy and hold bonds maturing in 2025, which means you as an investor, if you hang around till 2025, you have good certainty on the returns you're going to earn. So we launched these with target maturity structures, and we launched 2023 and 2030 then. In that issue, we raised about 12,000 crores. Both those products have done reasonably well actually in that period. And now we are coming back to the market again with the same AAA PSUs, but with a 5-year option for you and an 11-year option for you. So that is really what is out there. The first tranche went from 12 to 14,000 crores. Participation has only grown. And we are expecting with this tranche participation further grows.
So great, Radhika. We have heard few words coming out of your statements like debt ETF, target maturity. We would like to elaborate on both of them. What exactly is debt ETF? We have heard about equity ETF. And how does it compare with equity ETF? If you can answer that.
See, an ETF or an index fund or a passive fund, this is essentially one style of investing that is formula or rule based in nature. When people buy an active fund, whether it is a debt fund or equity fund, there is fund manager discretion as to what securities to buy, what securities to sell. With an ETF or fund of fund or any such kind of structure, it is really simple. You are benchmarked to an index. So every ETF is benchmarked to an index. And whether you look at an equity ETF, an equity ETF is benchmarked to an equity index. That index could be something like Nifty, for instance, or Sensex. With a series like Bharat Bond, you're benchmarked to the Bharat Bond indices. The NSE, which is the National Stock Exchange of India, for each of our series releases something called the Nifty Bharat Bond indices. They are published on the website. So there's a 2025 index, there's a 2030 index. So each of these ETFs is benchmarked to an index. The job of the ETF is to follow the index in line with SEBI guidelines. So for equity, you replicate the index exactly. For debt, if the index has a certain number of names, a certain number of bonds and issuers, you will hold those bonds with those credit qualities. And if it's a 5-year index, you will hold 5-year bonds. So that is an index. An index is an ETF, a rule-based vehicle that follows an index and does the index. And I think an investor that should give you a lot of comfort that there's no discretion here. It's rule-based. You know the index. It's published by a third party. It follows the index.
Great, Radhika. If you could explain why what is exactly is target maturity? Is it like a fixed maturity or is it something else? If it is similar to, fixed maturity, why we call it target maturity and where this concept came from?
So it is, and target maturity is actually very, very similar to, I think there are two words that investors may be familiar with, and fixed maturity is one. Fixed maturity or fixed deposit or any of these words mean that in a fixed period of time, I should get a return that is reasonably fixed. And that is where this notion of fixed maturity came from. Target maturity means that it means that today, if I launch the 2025 index, I will buy and hold those bonds, and I will buy and hold those bonds till maturity. Why we choose to call it target maturity is simple. We launch multiple such products. So we have a 2023 product. Now we'll have 2025, we'll have 2030, we'll have 2031. Globally, when we studied debt ETFs, we realized this notion of target maturity structures was very popular. In fact, globally, there are multiple kinds of ETFs. There are some ETFs that are constantly buying and selling bonds. They are called all-term ETFs in nature. And there are some ETFs that are target maturity in nature. What we've realized is that in the target maturity ETF, the customer experience is very good. So when you invest in a debt fund, one of your biggest concerns is duration. Okay, RBI is going to raise rates, RBI is going to cut rates. Mera kya hoga if this happens? Honestly, if I had a 3-year goal or a 5-year goal, I don't care whether RBI is raising rates or whether RBI is cutting rates. I just want my bonds till maturity. That is what the target maturity structure does. It buys bonds, it holds them to maturity. If you are a hold to maturity investor and you go to bharatbond.in, you are likely to realize a yield that is very close to the one that you see on bharatbond.in. And I think that's why we say target maturity. There are different target dates. I also like the word target maturity, because goals have targets. We have goals, we have targets. And I think you can align your goals to the maturity of this fund really, really nicely. Globally, as you said, these funds are some of the most popular debt ETFs. There's a company called iShares that publishes something called iBonds, on which we model the Bharat Bond series. And iBonds experience for customers has been very good. Deepak, over to you. You're on mute.
Great, great to know about the target maturity structures, Radhika. When anyone invests in any instrument, whether it's a fixed income or equity instrument, 3 things are paramount to investors' interest. And the first one that I'm going to talk about has taken a different dimension in last 6 months. So safety, liquidity, and returns. You have covered it in bits, but if you can elaborate in those 3 terms: safety, how does it take care of safety of people's principal? How has been the liquidity and returns that one can expect? from both the series?
Sure. So let's start with safety, because I think you mentioned the order: safety, liquidity, and returns. And I think the order is very well chosen. Safety is most important in fixed income investing. I think the last 2 years, people have realized that when we look at fixed income, first we want safety of capital before anything else. When we want to do equity, then we can take risk. I think in this product, we take care of safety very well. As I said, the construct is AAA, which is the highest rated companies, and they are only central public sector enterprises. I also want to reiterate that central public sector enterprises, because sometimes people think, ILNFS, it was not a CPSC. CPSCs are companies that are owned and management controlled by Government of India. And if something ceases to be a CPSC, it will not be part of the ETF. We can talk about that. So I think you are really looking at some of the largest issuers in the market. And in fact, if you look at bond markets, these are the companies that trade. These are the large borrowers. These are the ones that good quality funds hold. So your universe is very confined. I don't think you need to worry कि इसमें कोई bad paper आ जाएगा या कोई AA rated paper आ जाएगा. That AAA CPSC, I think, addresses safety. In fact, we were looking at a report that CRISIL published a few months ago, and no AAA rated enterprise CPSC has actually even been downgraded in the last 5 years. So I think that's also something important for investors to remember. While it's not sovereign, it's just next to sovereign. Second is liquidity. I think liquidity is extremely important, and this distinguishes this feature from a lot of traditional investments which are not as liquid in nature. Here, liquidity is anytime. You can enter and exit anytime that you want to. Obviously, we recommend that you come in as a hold to maturity investor, but if you do need the money, it is available. There are no FD breakage penalties and lower rates, and all that stuff doesn't happen. It's also very, very transparent in nature because all the details are on the website. So whether it's the AUM or whether it's the portfolio, everything is transparently available for you. I also wanted to make some comment on liquidity, because in the first issue, many investors asked questions about liquidity. You can buy and sell on the exchange if you buy the ETF. We'll talk about non-ETF options separately, Deepak. I'm sure you'll come to that. On the exchange, people have asked what the liquidity of this product is. I'm happy to say that we appointed market makers in the first tranche, and we continue to use them. On average, both ETFs have been trading 3 to 4 crores a day, and the bid-ask spread, and NSE published this data, has been in the range of 4 to 6 basis points. That's actually lower than the underlying bonds. So you are able to trade on the exchange. You're able to trade even 3 to 4 crores, and you're able to trade it without significant impact. I think these are the things that investors must remember. And this is in a period, March, April, May, where liquidity has been very challenging in the COVID period, where bond market volume has been low. So I think liquidity is something that is well established. Thirdly, returns. Two parts. One, you should visit Bharat Bond in for indicative sets of returns. But on the 5-year series, I think returns are in the 5.7-ish ballpark. Correct me if I'm wrong, 5.65 to 5.7. And I think on the other series, they're in the 6.7 to 6.8 benchmark. This is, of course, subject to where interest rates are. I think if you look at the post-tax returns on this, given the tax structure, both look very, very attractive. And maybe, Deepak, we can talk about comparable instruments later and how this looks. But those are the kind of numbers that investors can, look at. And I think at a time, we also launched the 5-year at a good time. A lot of investors are looking at 3+ year products because of the tax benefits. Today, the 5-year is giving you about 50 basis points over a 3-year product. So I strongly encourage even medium-term investors to look at a 5-year kind of product.
So Radhika, you mentioned about post-tax returns. So can you explain how will it be taxed? Will it be taxed as an interest income or as a capital gains as mutual funds are usually taxed?
Absolutely. I'm just going to explain taxation, and I'm also going to show the taxation illustration so that people can see it on their screen. The tax treatment of this is capital gains with indexation. It is just like debt mutual fund taxation. We've done some examples here on the 2025 and the 2031. Essentially, after 3 years, you're paying tax with indexation. So if you assume the rate of indexation is whatever, 4%, if you assume the inflation rate is 4%, that's the rate over which you're earning 5.71. 5.71 minus 4 is what you'll pay the tax on. So just keep that in mind. And I think we've done some examples here. If you see that on the screen, we are assuming an inflation rate of 4%. You see in 2025, a post-tax yield of 5.4 versus a traditional product that's close to 4, and 6.3 versus 5.1. I just thought showing these examples might make the post-tax benefits a lot clearer to investors.
Great, Radhika. If you remember a few years ago, a lot of tax-free bonds issuances had come and they're still available for investors to participate in them. How would, because if you look at the underlying IRFC, REC, etc., those are the tax-free bond issuers. How does Bharat Bond post-tax returns compare with those tax-free bonds?
So I think very good question. And one very important thing that you highlighted is that tax-free is of the same issuers. I think tax-free bonds, Deepak, correct me if I'm wrong, are quoting in the 4.5-ish kind of ballpark, or is it lower now?
Yeah, it is 4.5%.
4.5. So I think on a post-tax basis, if you look at the tenure product, for instance, tax-free is 5-year. If you look at the tenure product, you're at 6.3 on a post-tax basis. So there is a significant premium with high degrees of liquidity. Just coming back to your point on liquidity, same kind of or better liquidity terms with significantly higher yields for the same issuer in the market.
So great, Radhika, we've understood the product context, the background, but you mentioned that this is a product which is available on exchange. Is Demat compulsory for us to invest, or is there any other way out for retail investors?
Yes, and I think this is important. I know many investors, so those investors who have a Demat account should by all means use the ETF. However, there are investors who do not have a Demat account, who do not want to open one, and they don't like this exchange stuff. So we've got a fund of funds vehicle. A fund of fund is just a simple mutual fund that invests in the ETF. So there's going to be a 2025 and a 2031 fund of funds. Both will be open at the same time. Both are also reasonably well costed. While the ETF, everyone knows, is at 0.0005 basis points, even the fund of funds are at only 5 basis points each. With the fund of funds, you can purchase and exit just like you do with a debt mutual fund investment, and the tax treatment remains the same. So please remember, when you go anywhere, you can either invest in Bharat Bond ETF 2025 or 31 or Bharat Bond fund of funds, whatever you prefer.
But Radhika, we know that fund of fund charge their own expense ratio, and that could be very, very, very high. And I may actually lose out on a large portion of the returns. So how do you address that concern?
So fund of fund, in this case, there is a SEBI rulings that says the fund of fund expense ratio can't actually be a certain percentage more than the underlying ETF expense ratio. In this product, you know that the ETF expense ratio is 0.0005%. As I said here, the fund of funds, we've kept it at 0.05%. I think, Deepak, that is probably cheaper than any liquid fund also. It's probably the cheapest fund of funds in that. So, you know, you don't have to worry from an expense ratio point of view. Also remember, and this is not a problem with the ETF, in the ETF, you choose to pay brokerage and spread. In the fund of funds, you don't pay that. So you can do your own calculation as to what works for you. That 5 basis points a year.
Charges, etc. So at 5 basis point, it becomes very convenient for small investors.
Exactly. So we have tried to make sure that for small investors, there's actually no harm. Either option is as lucrative for them.
So Radhika, you last time you had launched 2023 and 30, this time 25 and 31. Is this very random, or is there any thought behind it that you put, or your sales guys just decided and you launched it?
No, so we do listen to the sales guys, but I think if you look at the more important thing, I think the FM, when she launched Bharat Bond, said that Bharat Bond is not a product, it's a program. And that program is going to have a ladder. So over time, what we would like for retail investors and all investors is that you have a 2031 and a 2023 and everything in the middle. So tomorrow, if you want to invest in a 2-year product, a 4-year product, and a 7-year product, and globally this is called laddering, basis your goals, you just choose the Bharat Bond. I mean, I would love to see people's debt portfolio only being Bharat Bond. That would be a great outcome. So the launches are not random. We felt we had a short-term product in 23. We felt that 10-year existing 2030 is now 9.5 years. We said we'll do a long-term product, which is 2031. 5-year, we said, gave people a good sense of indexation. So after 3 years, you get indexation, but the yield is also 50 basis points higher than a 3-year. And there are not too many 5-year products in the market. So we feel now you have 4 options on the curve already to choose from in Bharat Bond. And my hope is we'll fill the curve, and hopefully the sales guys will also agree.
Great, Radhika. The question is with regards to safety. I'll just come back to that. You said that we will be only investing in AAA CPSCs. So what happens if they, neither remain CPSC nor remain AAA? I mean, either downgrade or disinvestment. How do you address those situations?
So let me take downgrade and then we'll take disinvestment. And these are obviously the 2 toughest questions that anybody gets asked in this environment. Downgrade, the index specifies that it has to be AAA CPSC. If it ceases to go be AAA, then we will in an orderly way, it will go out of the index on the rebalance, and it will go out in an orderly way from the fund. I want to make one point that I was telling a large institutional client today morning, which I think is relevant to know. When you go from AAA to AA plus is still a very, very high rated bond. Usually that bond is very liquid in the market because there are lots of people who are buyers for the bond. So AAA, when we hear downgrade, we feel default, mera paisa wapas nahi aayega. A downgrade sounds like a very scary thing today. A downgrade from AAA to AA plus is not as scary as a thing that people make it out to be. I also want to reiterate the fact that CPSC AAA downgrades are very, very rare. That said, it is a valuable question to ask. The second question is around disinvestment. Yes, we can only hold companies that are CPSCs. The good news is the department that runs this project is also the Department of Disinvestment in India, that is DPAM. So we have reasonable color on anything that is likely to be disinvested. And disinvestment is a long process. I mean, you've heard about Air India, and that's not happened for a long time. After cabinet approval of disinvestment, we can take this out of the index and we can take it out of the ETF. And believe me, between cabinet approval and actual disinvestment actually takes a long time. If there are any companies that are up for disinvestment, we actually exclude them in the ETF. So like we don't have BPCL in these ETFs right now. So that's also something that we are cognizant of. And remember, disinvestment again is not necessarily bad news. Disinvestment can go into a stronger hands, but it's not in the mandate of the product, of course.
Thanks, Radhika. Now we'll start taking questions from the participants. There are a lot of them, and I'll take one by one, and I'll try to take all of those questions because this is a webinar for them only. So the first question comes from Mr. Somala. Does the Bharat Bond reconstitute the components percentage share depending upon respective performance and their ratings? So Radhika, I think the question is about rebalancing. How does the rebalancing happen? If you can throw some light there.
Yeah, and maybe I'll just give you a quick slide on index methodology because I think this is important. So how is the index constructed? This is how the index is constructed. You look at AAA rated bonds issued by public sector companies, and they have to have these bonds that are, so if you're doing a 5-year index, you have to have bonds maturing within 12 months prior to the index maturity date. Now the weightage of the bonds, which is the question that you asked, is based on the outstanding amounts of bonds. That the higher the outstanding, the bigger the borrowing, the higher the weight. So you'll see companies like PFC or REC carry a higher weight than some people who are smaller borrowers. And then the exposure to a single bond is capped at 15%. These bonds, this index is rebalanced quarterly. So if the bond universe changes, if the outstanding amount changes, there will be rebalances. I will tell you, having seen 2 rebalances, the rebalances are very slight. You don't want this index to have huge turnover or the ETF to have huge turnover. So that's not happened. It's not that if one CPSC is doing very well or its stock is doing well or its bond is doing well or its returns are great that you change it. It's based on the outstanding amount. And I think going back to the rule-based investing, it's all very rule-based.
Radhika, your network seems to be giving some trouble. So
okay. Is it okay now?
Yes, it should be. When you mentioned outstanding, just for simplification's sake, outstanding means the amount of bonds which are due to mature in a given period of time. So that is the meaning of outstanding for everybody's sake. Radhika, the next question comes, if rates move up, which is likely in next 3 to 10 years, the fund will have to have MTM, which means the only choice for the investor is to hold to maturity. Is the understanding correct?
So yes, if rates move up, then there will be, from here, there could be negative MTM. If rates move down, there will be positive MTM, which is why we are re-emphasizing again and again that if you are looking at the rates that we are quoting today and expecting to earn those rates, then it is a hold to maturity product. It's a target maturity product in construct. So in the middle, there could be MTM. I'll also say in the first series, Deepak and I remember the NAV going to 998 and 997 sometime in March, right? And then we've seen it go up. So for hold to maturity investors, there's nothing to worry about. In the interim, you should be prepared to see mark-to-market volatility. But remember, it is mark-to-market volatility.
But we have done some analysis both on 10-year as well as 5-year. If rates move up by 50 basis point to 75 basis point in 5-year as well as in 10-year, in 5-year, you still get returns which you will otherwise would have got in 3-year investment, because 3-year returns today are at 510 and 5-year is offering you 50-60 basis spread over the next 3 years. So even if some yields were to move up within that next 3 years, it will still give you returns in the which is similar to that of a 3-year product. And why I'm saying 3-year, because I'm assuming that your taxation is favorable for this product. Otherwise, there are other products also that you may look at. Second, on the 2031 side, sir, the rates are very, very attractive in terms of spreads between 3-year and 5-year. So even if rates move up by 1%, you still make more than what you would make in 3 and 5 years. So from that perspective, it is not entirely hold to maturity, but yes, you should come with a minimum horizon of 3 to 5 years, depending upon which series you choose. The next question is, what is the difference between FMP and Bharat Bond ETF as a product?
Okay, so difference between FMP and Bharat Bond. First difference is Bharat Bond is completely open-ended in nature. FMP is not open-ended in nature. Second is FMP has fund manager discretion, actually complete discretion on what to buy. Bharat Bond is index driven, it's passive, it is completely rule based in nature. And third difference I would say is Bharat Bond is significantly more transparent than an FMP and also more cost effective to the investor than an FMP. So I think these are the 3 key differences.
So there's a question on a group, Edelweiss Group and a fund of fund. Yeah. So the question is, I'm a retail investor, I'm considering investing in fund of fund. I would like to know, would anything with regards to group's financial condition have a bearing on the safety of the fund of fund?
Okay, so I just reiterate that AMC is an independent, regulated and ring-fenced entity, and not only with respect to Bharat Bond ETF, but to all products of Edelweiss Mutual Fund. They are ring-fenced from the corporate in good and in bad times. So it will not have an implication for asset management company investors. That's not something you should worry about. Incidentally, and while this doesn't pertain to Bharat Bond ETF, I'll also mention Edelweiss AMC also does not hold the debt and equity of its parent company. That's not a reflection on the parent company's debt and equity, but that is our own corporate governance policy. So I think you should separate parent and this issue completely.
The next question is, will the next series of Bharat Bond ETF or thereafter have lower rated papers, as some Government of India folks have stated to the media?
I'm very glad you asked this question, because that statement has created some confusion. What the media had asked, and you can hear the press conference, is at some point, will AA papers be included? And Secretary said, depending on market environment, we can see and evaluate. We'll see. Let me clarify a few things. The last series and this series are AAA series and only AAA series. The NSE index and the SEBI filing reflect that, and they have to be AAA series. If any AA has to happen, it cannot happen in these 2 series. It has to be a fresh series with a fresh set of rules and a fresh index. As of now, there is no immediate plan, even in the future, to launch anything less than AAA. We rather more investors trust and adopt this product, and later as the market develops, we'll see what will happen. But right now, nothing on the cards. Very important question.
What guarantee that it will not be suspended like some other funds suspended their funds? I'm not taking name, Radhika.
Yes, of course. So I think, I understand the degree of credit concerns that have happened. I would say Bharat Bond is quite the opposite of credit related funds. It's a AAA rated fund. And remember, guys, this is a project overseen and under the aegis of Government of India. Edelweiss, while we are very proud to be associated with it, is ultimately just an asset manager. So it's a Government of India project, and it's a project to deepen retail participation. I think that kind of project, to see things suspended, is a very, very different kind of scenario. Please remember that for holding AAA rated bonds of CPSCs, the highest rated bonds and the most liquid bonds. So I think while I understand and empathize with what has happened, do separate it from where we are.
Are returns predictable? Would one get the indicated yield if he or she holds until maturity?
I think Deepak, returns are reasonably predictable. The one point I must highlight is that the bonds give coupons, and the coupons have to be reinvested every time they come in, annually or semi-annually. Those will be at prevailing market rates, lower or higher. So there could be some small degree of slippage in terms of coupons. But other than that, for hold to maturity investors, our experiences, they have been predictable for hold to maturity investors.
So Radhika, this question is on downgrades. Have you, in your experience so far of managing Bharat Bond ETF first series, had any downgrade, and if any, how was it managed?
No, we haven't had any experience in the last 6-7 months, but it's a 6-7 month history. As I said, perhaps more usefully, CRISIL has said in the last 5 years, no AAA CPSC has seen any instance of downgrade. So that might help you a little more.
Slide number 16, can you please explain maximum investment limits of 2 lakh for individual investors? Radhika, I think this is for the category, basically.
Yes, there are two categories under which people can subscribe: retail and non-retail. 25% of the issue is reserved for retail, 75% for everyone else. If you want to apply in the retail category, the maximum amount is 2 lakhs. And for every other application, it becomes non-retail. So your call, there's no limit on how much you can apply for, but if you want to apply for the retail category, then it's this. These categories are only relevant if the issue crosses 14,000 crores, in which case retail investors will get preference over other investors.
Radhika, what's your view on interest rate? Do you anticipate any more cuts? And if yes, could be the potential timelines for the next rate cut? What could be the potential timelines? Or do you think that we have seen the last of rate cuts and the repo rates can only go up from here?
So I think you and I and Dhaval, who's our fixed income head, was saying that we are seeing right now some of the lowest interest rates that we are seeing in our career in India. That said, we are also living in extraordinary and COVID times. Globally, interest rates are at zero. So could things come down lower if economic conditions remain this subdued? Could the RBI cut rates further to push up growth? It is a certain possibility. Could India also go through a significantly long period of low interest rates? I think that is also another reasonable possibility. I think it's very hard to predict, but could we stay in a period of prolonged low interest? Could be. I don't think the past here is a gauge of the future.
So many of the people who watches the credit market and have some kind of a command and expertise have been saying that even at current rates, NPAs may continue to rise. So with that being the context, it's very difficult for central bank to raise rates unless it is compelled by inflationary scenarios, which has also been very well managed by both by government and the RBI. And globally, nobody is talking about inflation as of now. Can this be treated safe as bank FD?
I think it is one of the safest debt MF products that is out there. I think you don't, sometimes the comparison to bank FD and Bharat Bond is a little unfair because a bank FD doesn't get mark to market on a daily basis. We have also seen, without taking names, commercial banks being frozen in India. So while the debt MF industry comes in for a lot of criticism, the banking sector has not been spared. I was also a customer at that bank, so I know what I went through in that period. But I think, it is as safe an instrument as you can get outside of sovereign. That's what I would say. Deepak, if you have anything to add to that.
No, Radhika, thank you so much. Given that the interest will be received by the ETF on a certain frequency and it is annual, just to answer that question, which needs to be reinvested, how does that impact the returns of the ETF? You have mentioned it, Radhika, if you want to explain this.
Yes, I agree saying that. So you get coupons. We do not pay the coupons out because if we were to pay the dividends out, they would be very tax inefficient. So we reinvest the coupons in the same bond in the same proportion. Now, those bonds are invested at prevailing market rates. Those prevailing market rates could be higher or lower depending on interest rates. So to that extent, someone asked, are the returns predictable? I said that is the 1 point of slippage. It's not a very large point of slippage. Probably its impact is 5 to 10 basis points in my estimate, but that's something you have to keep in mind.
So Radhika, two questions. One, I've invested in equity ETF of CPSE and I lost money, and I fear losing money in this as well. Second, how are the indicative rates supposed to change, or will it remain fixed till maturity?
Okay, so the indicative rates are indicative rates and they'll change every few days till the NFO. Obviously, a year later, the 2025 instead of a 5-year product may become a 4-year product. The 4-year rates will be what they are at that point in time. If 4-year investors want to come in, they'll get what they do. Current investors who invest today will get the indicative rate, but a year later, what the indicative rates will be like, I don't know. For instance, in the 2030, when we started, Deepak, I think the indicative rate was 7.5, 7.6 in the last issue. Now it's probably 6.5, 6.6. So it changes with time. The first question was what? CPSC. Yes, CPSC. Okay, so I think both are completely uncomparable products. One is an equity product, one is a debt product. This is a debt product with predictable returns and safety. That is investing in the underlying stocks of CPSCs. My own view is that, while we have always complained about public sector companies in terms of their ability as capital allocators, their stock, etc., I think from a bond point of view, the lending ability of public sector companies, this is the strongest segment in the market from a lending point of view. So I would not, the names are very similar, Bharat 22 and this, I would not color your equity experience with fixed income experience.
There was zero charges on the exchange for buying Bharat bonds. Will it continue in new series? I don't know if it means NFO or post NFO, but NFO, yes, it will. One can buy from exchange mechanism directly.
Yes.
If a security gets downgraded, then I hope it will get out of ETF only on quarterly rebalance and not immediately. How does that have impact on returns, if any? We've covered.
Yeah, we've covered this, Deepak.
Does AMC also provide liquidity on ETF's redemption?
What do you mean here? So when you want to redeem the ETF, you go to the exchange and you redeem the ETF. And there are market makers who will facilitate the redemption of the ETF. 25 plus crore investors can come to the AMC directly. So the AMC will provide liquidity above a certain size. FOF investors come to the AMC directly.
Also, if you can explain that liquidity that provided to market maker, that also happens via AMC.
Yes. So the way this works is what happens when you go to the exchange. You're not talking to the AMC when you go to the exchange. There are intermediaries called market makers who are buying and selling bonds on the exchange. If the market maker is seeing a lot of buying demand on the exchange, what he will do is give cash to the AMC, buy bond ETFs from the AMC, and then give it to investors. If he's seeing a lot of selling pressure, then the AMC will provide him liquidity, vice versa. So the market maker is an entity that stands between the customer and the AMC, and the AMC provides liquidity via the market maker.
Please take us through the factors impacting NAVs, both upside and downside on a day-to-day basis.
Okay, so I think the factor that impacts bond NAVs is very simply interest rates. I'll give you a very simple proxy to this. Just the basic bond math. Today, if I issued a bond and, let's say Deepak was a bond market trader and I had a bond that was delivering a rate of 5% coupons on a base price of 100 rupees. So that bond has a value. Now, tomorrow, if interest rates went to 6%, obviously my bond that has 5% coupon is going to be less valuable. Deepak would pay me less for it than a bond at 100 delivering 6%. So if interest rates move up, bond prices move down. That is the factor that impacts NAVs in the interim.
Are the yields fixed for 5 years? Since not, how are these bonds better than dynamic bond or corporate bond funds with AAA instruments where YTM is between 6.25 to 6.5%? I don't know which are these bonds, Radhika, but if you want to answer.
Okay, so I don't know which bond funds are between 625 to 650. I think with dynamic bond funds, there are two challenges. One is dynamic bond fund is an actively managed fund. So it could be AAA, it could be AA. It's really the fund manager discretion. I don't think that's that. Secondly, dynamic bond funds carry duration risk. The predictability of returns is not as high there. Please do realize, and I think the one thing I would tell you is net YTM in a dynamic bond fund is not equal to the return that people will realize. I will also say this in gilt. A lot of investors are rushing to gilt funds today, not realizing that there is significant duration there. If interest rates move by 1%, that will move by 6-7%. So I think this instrument gives you significantly more degrees of predictability than a dynamic bond fund or a corporate bond fund, at lower cost, significantly lower cost.
Radhika, again, a question on safety. Is there any, safety net like insurance in worst case scenario?
No, there's no insurance. I think you can't guarantee returns as per SEBI. I would only say that, the safety is in the construct, in the passively managed, in the universe, and the fact that it's a Government of India initiative.
Presentation shows returns for existing bond in the range of 13 to 70%. Will you elaborate how is it so high?
Yes, and I think you should not, that's an important question. Here, this is what you're referring to. When the first tranche was launched, after that interest rates have fallen almost 1%. So remember the 5 and 6% bond example I gave, there's positive MTM that investors have benefited from. I will tell you that the 2023 and 2030 investors, if they hold to maturity, they will still get what was on the website at the time of launch. They will not get 13%. Right now, because interest rates have fallen, their returns look like 13 and 14%. If they exit today, this is what they'll get. This is a benefit of interim mark to market. You could have the reverse also. As I said, don't go by this, go by the indicative yield as a hold to maturity investor.
Will retail investors be able to apply through ASBA in the new Bharat Bond series?
There's no ASBA in this series, right? People correct me if I'm wrong.
No, there is no ASBA.
Typically, mutual fund offers don't do it.
All the questions, we have taken almost all the questions. We have answered more than 30 odd questions. There are still questions on expenses. The expenses 0.0005 on ETF, 0.0515 on FOF, one of the lowest cost products, not in India, but world. Difference between return in Bharat Bond Series 1 and current series, like every bond issuance, the ETFs will also carry different maturity and different yields. So your returns will match basically on the date of investment only. How is Bharat Bond different from PSU bond mutual funds? If Radhika, if you want to answer that, let's just come.
Yes, PSU bond mutual fund. So I think there's a category of banking and PSU debt mutual fund. I like this category. Now within banking PSU, a lot of things happen. In bank PSU 1, some of them are not target maturity structures. In fact, I reckon most of them are not target maturity structures. Most of them are 2 to 3 year in nature. So that's very different from your 5 and 10 year target maturity structure. Bank PSU also has bank bonds. 20% of the universe can be outside bank PSU. And again, it is actively managed. So I think those are the two differences. And of course, third, cost is a significant difference.
So Radhika, if you can explain how people have got convinced how to apply and how to invest, if you can explain.
Very important one. Okay, so there are a few ways to apply. You can apply for the ETF through your broker. Any broker will have this. You can apply on the exchanges through your broker. You'll need a Demat account. You'll need a broking account. I think all major brokers in the country are supporting this. For FOF, you can make an application through your financial advisor, your wealth manager. If you want to make a physical application, you can make it. Or if anyone is confused and doesn't have any of these things available, I recommend you visit www.bharatbond.in. You will be able to make an ETF application and a fund of funds application. So to reiterate, ETF through your broker, fund of funds through your financial advisor, wealth manager, a physical application like a mutual fund. If you're lost with options, bharatbond.in is the last place you can go, or the first place you can go. And by the way, you will be able to transact. We'll release this next week when the NFO opens. You'll be able to transact on a chatbot. You'll be able to buy on WhatsApp, and you'll be able to integrate with your NSDL and CDSL accounts on bharatbond.in.
Thank you so much, Radhika. You have been so wonderful that there are no more questions. Even after waiting for 2 more minutes, questions have not come in, which means all of them will invest and in bulk. So everyone no, it was just on a lighter note. Thank you everyone for joining in for this session. We really feel delighted to have answered all your queries. We are available 24/7 to answer your questions and to help and guide your investment queries, be it Bharat Bond or otherwise. Thank you so much for joining in. With this, we come to a conclusion of our call today.
Thank you so much, everyone. Thank you for joining us, and we look forward to your support, participation, and feedback on Bharat Bond. Reiterating what Deepak says, the team is always available to answer questions. So just reach out to us on email, social media, whatever it is, always available to answer questions, and do visit bharatbond.in. Thank you. We'll conclude.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.